As a matter of policy, we remind you to please keep your mask on while you're not actively eating or drinking today, so that we can keep each other and ourselves safe. I do want to say we have a couple of accommodations as a result of the pandemic. People are joining us on Zoom virtually, so welcome to all of those joining us on Zoom. If you want to keep your mask on during the entirety of today's program and eat later, we do have to-go containers available, so please flag one of our staff and we'll provide you a to-go container to take your meal with you. And the last piece of housekeeping that I have is please feel free to use social media today. The hashtag is BF2022. So let me start today's event by thanking our sponsors. We wouldn't be here today, or really any of the past 28 years, if it weren't for our very generous corporate sponsors. And so if you'd please turn your attention to the screen, we have a presentation of our sponsors.
The Walton presenting partners are Walmart and Sam's Club. The Walton academic partners are Greenwood Gearhart Incorporated, RMP LLP, Attorneys at Law. The Walton corporate partners are Arkansas Blue Cross and Blue Shield, Chase, Cox Communications, Cushman & Wakefield, Sage Partners, Devereaux Real Estate Investments, Regions Bank, Steve Feinberg and Associates, Wright, Lindsay and Jennings LLP. The Walton business partners are American Electric Power Foundation, Buffington Homes of Arkansas, LLC, CBRE Incorporated, Centennial Bank, Colliers International, Connor & Winters, LLP, Encore Bank, Entergy, Frost, PLLC, Hogan Taylor, LLP, Iberia Bank, First Horizon, JB Hunt Transport Services, Kutak Rock, LLP, Landmark CPAs, Mitchell, Williams, Selig, Gates, and Woodyard, PLLC, Nabholz Construction, Quattlebaum, Rooms and Toll, PLLC, Riverwood Homes, Simmons Foods, Incorporated, Smith Hurst, PLC, Wise Invest Realty, LLC. The Walton Media partners are AMP, Talk Business and Politics, NWA Business Journal, and Celebrate Arkansas.
Would you please give a round of applause to our wonderful sponsors for helping make this year a great success. Today's event is held in conjunction with the National Association for Business Economics. All panelists, Dave, myself, and Juhi, are members of the board, and Dave's actually the current president of NABE. So we do every year awards at Business Forecast. If you'll look on your tables, there's a blue form with some economic indicators on there. We ask you to predict the values of 15 economic indicators, and at the next luncheon, we usually give awards to the best Dow Jones forecaster and the three best overall forecasters. So last year we did this online, and y'all provided your consensus forecast, and I'd like to, mention a few highlights from that. The consensus forecast for GDP from this group here was 2%, which is incredibly low. You only missed by about 3.5% for the year. I don't know what you guys were thinking. I guess you were expecting more gridlock in Washington, D.C., but you got the calendar dates wrong. Gridlock in 2022, it was all gravy in 2021. The flip side, your predictions for inflation were overly optimistic. All of you had predicted your consensus forecast for inflation was a paltry 2%, which you also missed by about 5%. But don't feel so bad for yourself. You're in such elite company missing inflation estimates as the Federal Reserve as well. So at least your logic was internally consistent. You had low GDP and low inflation rates. You didn't go for low GDP and high inflation rates, so we didn't miss the stagflation bit of it. So now I'm going to announce who of you won the most accurate economic forecast in 2021. The first up is the winner of the Dow Jones Industrial Average Forecast, and that is Blake Pennington from the city of Fayetteville. Congrats, man.
Thanks.
Our third place overall forecaster is Julie Trivet from Heartland Forward. Julie's an actual economist, so sometimes we do win these things. Our second place forecaster is Brian Etihad from Frost PLLC. Brian's an accountant and somehow managed to beat an economist. I don't know how that happened. And the top spot for the Dan B. Grubb Award for Best Economic Forecast goes to Kelly Johnson from the Northwest Arkansas National Airport. Now, Kelly won third place last year and won first place this year, so you might want to find out what her secret is. Congratulations.
Thank you, Mervin.
You must know what you're doing.
Please join me in a round of applause for all of our winners. Maybe next year we'll include an economic indicator for your prediction for what the value of Bitcoin is going to be, and the grand prize can be 1 Bitcoin. I'm joking about that. We can't afford 1 Bitcoin around here. But please fill out the forms that are on your tables. There's a QR code if you want to fill that out digitally. We'll have the QR code on the screen as well for those of you that are joining us online. Now, please help me welcome Matt Waller, Dean of the Sam M. Walton College of Business.
Thank you. Good afternoon. Welcome. We are so glad to see you all again. It's been a couple of years. It's good to see old friends and good faces, so welcome. The turnout is much better than I could have expected. You know, at the Walton College, we're working hard every day to really support state needs and regional needs, and especially in the areas of innovation and to overcome challenges we face today and tomorrow. One way we're doing this, I'd like you to be aware of, this is kind of a new thing that is worth noting. It's actually a big deal for the region, is through our business incubator programs housed at the Greenhouse, which is located at the Bentonville Collaborative. I don't know if you're familiar with that, but it's worth looking into. These programs provide small business support as well as deep product incubation for Arkansas entrepreneurs and startups. The Greenhouse Outdoor Recreation Program, which we've got a great name for it based on the acronym GORP, I think that'll stick, started its first 12-week program this week. And GORP is a business incubation program that will support entrepreneurs who are creating innovative products and services in the outdoor recreation industry. GORP will develop entrepreneurs from Northwest Arkansas and the Heartland region, as well as University of Arkansas students that are entrepreneurs, of which there are more and more. This program really capitalizes on our state's growing reputation as a player in the outdoor recreation industry. Arkansas is the natural state, and we have advantages here that really give us an opportunity to leverage in this way. In addition to GORP, the Greenhouse will house 2 other business incubators we'll announce later, and will also have membership programs for entrepreneurs. And these members will have access to co-working spaces, student interns, consultation, regular workshops, and community building events. It's pretty exciting. By supporting innovation in key industries, spaces like the Greenhouse really help to build a better and stronger climate for business in Arkansas. Another thing I'd like to point out, when I came up here 2 years ago to talk, you know, we had a few master's programs in business like the MBA, the Executive MBA, the Master's in Accounting. We've added a lot of new master's programs based on demand in things like supply chain management, applied business analytics, information systems, economic analytics, healthcare EMBA, accounting, executive MBA, full-time MBA. We've got lots of master's programs that you might want to look into if you're thinking about maybe pivoting in your career or just advancing further These are brand new programs, many of them. It's now my pleasure to introduce today's moderator, Brett Biggs. Brett Biggs is the Executive Vice President and Chief Financial Officer of Walmart. He has also been Chief Financial Officer for Walmart International, Walmart US, and Sam's Club. Brett is an active civic leader serving on the American Red Cross Board of Governors, the Walton Arts Center Board, the Board of Trustees of the National Urban League. Please help me welcome Brett Biggs. Thank you, Brett.
Good to see you. It's such great energy. It's like we haven't seen each other in a long time or something like that. It's, as I was sitting up here looking at this audience, I think the last time I might have been in a room with this many people was a couple of years ago in this room for a fundraiser. It's been a while since we've been together, and it's so great to see everybody here. I want to thank Dean Waller and thank the University of Arkansas for hosting this event. We'll talk about a number of heady things this morning, but I don't know if, like you, I was personally just happy I found my suit. It sort of still fit. I can tie a tie. Like these small victories in life we've learned to celebrate over the last couple of years. And in preparation for this event, I was going back and looking at the 2020 event. There was no masks. There were handshakes, which I guess we're shaking hands again. I'm not sure, but I think we are. No mention of COVID. A lot of things have changed, certainly in the last couple of years. And when it comes to forecasting the economy, there's a lot of uncertainty that we're all facing, whether it's COVID, inflation, labor markets, geopolitical situations, and the like. So it's great that we have experts with us this morning, or almost this afternoon now, to help us make sense of it all, and I'll introduce them in a minute. And I think we should all wish them a very hearty good luck on talking to us about forecasting the economy. And the people that just won awards, that's incredible, and my guess is you're going to have a lot of people wanting to get you on their team before you leave here today, because that's incredible that anybody could forecast 2021 with any certainty. And we promised to all the panelists we won't play this back next year. They might, I don't know, I just thought I'd say that. And while we're navigating all these headwinds, though, I think it's easy to lose focus of all the opportunities that are in front of us. There's an amazing amount of excitement, change, and opportunity, and I see that from the Walmart perspective, but you see it from your perspective as well. Things like the consumer, and the consumer continues to evolve very, very quickly, and that provides opportunities for both large businesses and small businesses. And businesses continue to become more digital. I know we are obviously at Walmart to reach those customers, but that ability to become digital is just as easy now for small businesses as it is for large businesses. Everything is changing in that regard. Technology continues to evolve at an incredible pace. I was thinking about it. I'm sure a few of you have this smartphone. It was only introduced 15 years ago. The iPhone was introduced 15 years ago, and today it's a part of our being almost, that we wouldn't know what to do without it. Things like social networking didn't exist almost 15 years ago. Go back 25 years ago, and the internet was barely a thing. So as you think forward to the next 10, 15 years, what is it going to be like? Things that we probably scoffed at a few years ago, drone deliveries, autonomous vehicles, blockchain, all of those things are now right upon us and are right around the corner. And now we're talking about things like Web 3.0 and the metaverse. Many of us hadn't heard about the metaverse about 6 months ago, and here we are now, everybody's talking about the metaverse. Things are evolving very, very rapidly. So it's pretty easy, I think, in today's environment to focus on the challenges, but it's really important to stay focused on the incredible opportunities I think are in front of all of us. We're all blessed to be in an area of the country that's growing, it's evolving, it's innovating. I've been in Northwest Arkansas now for most of 22 years, and it's almost unfathomable what has happened here in this part of the world. And I actually have one question. I'm going to give them a head start on the panel, but I've got one question I'll give to the panelists later, is not if, but when this area is going to hit 1 million people. That may seem like a lot. When I moved here, there was maybe just under 200,000. Now we're pushing 600,000. And if you're driving around lately, you can tell there's a lot of people that have moved to Northwest Arkansas. So it's a very exciting time to be here. So there's a lot of context that we'll get out of the meeting today, and the discussion today, that I think will help us think about the challenges that we're facing today, but also the excitement of what's coming. So before I introduce our first panelist, let me introduce how the program is going to work. Each of our experts is going to give a brief overview of their forecast starting. We'll start with the global economy, then the US, and then finally here in Arkansas. And after all the panelists have spoken, we'll come back and have a discussion where you can submit questions. I believe there are green index cards should be on your table. And if you have a question, those cards will be collected following our last speaker. So let me introduce our first panelist who's with us on video today is Juhi Dhawan. Juhi's a senior managing director, partner, and macro strategist at Wellington Management, a private independent investment management firm with client assets under management totaling over $1 trillion. As a member of the firm's global macro strategy group, her work on growth, inflation, interest rates, and economic policy is core input to portfolio managers and analysts across the firm. And prior to joining Wellington, Juhi held positions at the International Monetary Fund and at the World Bank. She's a member of the board of directors of the National Association of Business Economics. So please help me welcome Juhi to the 2022 Business Forecast Luncheon.
Hello, everyone. Thank you, Brett, for that generous introduction. And I am thrilled to be sharing some thoughts with you today. University of Arkansas, I am grateful for this opportunity, and I hope that the next time we do this, we will absolutely do this in person. I am Juhi Dhawan, macro analyst at Wellington, and it is truly my privilege to share some thoughts on the global outlook with you today. If I had to choose a phrase to describe the year of 2022, I'm going to say this is the year of normalization. First and foremost, every outlook in the last 2 years has been about the state of COVID. So when I think about the progress that health has brought to us, it is that we believe that vaccinations will win this battle over COVID during the course of the year. We all know that we are currently experiencing quite a substantial wave through Omicron, but the good news is that we are continuously increasing vaccination rates. How will this year normalize? We believe that the very exceptionally high growth and inflation rates experienced in the United States will start to come off some as the supply pressure ease. We think that Europe and Asia, who were harder hit last year in comparison to the United States, will recover as lockdowns ease and activity normalizes. This year of normalization will also see less accommodative central banks and fiscal policy in the West. The one exception in the global economy that's important to really highlight as going the other way is China, which has just started the process of easing monetary policy as growth has slowed down and concerns over the property slump continue to linger. Evolution of supply chains is an ongoing theme. And when I think about a multi-decade theme that I would really want to share a couple of thoughts with you today, it's that the energy transition and climate change are making a big difference. Some of the risks to highlight for this year as we think about the outlook, COVID continues to be in the news and remains part of our mosaic. Geopolitical noise is going to pick up over the course of this year, we believe, as the US faces midterm elections, but there are also important elections coming up in Europe and some of the tensions that we have seen in the Asia region. Amongst the other risks, we are setting ourselves up for the start of a process of Fed normalization, and there's always a risk that the Fed is unable to calibrate this process finally. So let's talk a little bit more in detail about each of these ideas. So when I look at this chart here, we're looking at the global PMI across the world. And we can see that China has been at the break-even level for quite some time and is just starting to turn. And US and Europe, which were quite elevated, are starting to slow down. The world as a whole gets less divergent in 2022. One of the themes that we continue to highlight for the global economy is the normalization of the service economy relative to the goods space. The service economy is continuing to improve as it is still below trend, areas such as leisure and healthcare are still areas where we think the recovery is incomplete. In contrast, as shown here, that dark blue line for durable goods is quite elevated, and that process of slowing continues to take place. This is not just true for the US, although this is US data, but a theme that resonates across the world. One of the themes that has hit the world economy and has been in the spotlight for a long time over the last year was inflation. I'm using US data here because the US has been one of the hardest hit countries in terms of the inflation rate. And this shows and divides the inflation into two pieces. Flexible inflation, as shown by the aqua line, which is running well above what we've seen for a very long period of time. And this really relates to those categories in the CPI that can move quickly. Areas such as autos, energy, food, some of these very high frequency data are seeing pretty elevated prices as shortages have been prevalent. On the other hand, we have what we call sticky CPI, which is also rising, but at a little bit more contained rate than this. Sticky CPI is running at about 4 percentage points, or a little shy of that. And a big component of that is shelter inflation, which, as we know, is quite high. Our expectation is that as bottlenecks ease over the course of the year, this aqua line will come down towards the sticky CPI, giving some much needed relief to consumers and companies who are feeling the pain of these bottlenecks. Let's now turn to Europe and take a look at the recovery here. Here we're showing you the case count in the dark blue line, and then the aqua line shows you the fatality rate. And what we can see is that while Omicron has been one of the most or pretty strong and devastating in terms of the infection rates across the population, the actual fatality rates, thankfully, have been lower. That's very important, obviously, for all of us, because health comes first. And so we're happy to see that we are starting to get some impact from the vaccination processes that have been ongoing for quite some time. We do believe that this wave will peak in coming months. And as it does, there will be a reopening taking place in Europe, which has lagged behind. The other reason to feel good about Europe comes from the financial conditions in Europe. So when I look at the monetary conditions index here, that's the dark blue line, it is quite easy in the euro area. We've circled this period in 2011 through 16, which was last time when Europe went through this phase where conditions were quite tight after coming out of a recession. And we want to highlight in particular this difference in policy that has been put in place in Europe as a reason to believe that the recovery can be quite robust this year once we get past this current wave of the crises. So a little bit more growth coming out of a region that has underperformed for quite some period of time. Let's then take a look at China. China's property market slump has been a drag on growth. We're looking at construction starts here, the dark blue line, and they are declining. And those under construction also look to be heading south. This is obviously a very large part of the Chinese economy. And as we know from our own painful experience post GFC, housing and construction can have a pretty detrimental impact on an economy. So it is important for the authorities to take appropriate measures to try to stem this slump. We are starting to see the monetary conditions index in China ease. That's the dark blue line here, which is as it's heading higher, conditions are starting to get easier. And you can see that this has been the pattern for the PBOC in recent years, that when real estate prices start to move lower or start to ease off, the central bank does take notice and starts to ease. We think that will help put an important floor in prices for that part of the market or the global economy, which has been quite weak. Turning then to central bank policy, right? We just talked about a global growth picture, which is going to show a little bit less divergence than we saw in 2022. This is being accompanied at the same time by those rising inflation pressures. So while we are hopeful that the supply chain pressures ease, we also want to keep an eye out on the labor markets. As we know, the Federal Reserve has a dual mandate, and it is important to keep in mind that we have seen a very strong recovery in the labor market. So when I look at the employment to population ratio here, you can see that it is recovering quite nicely relative to where it was prior to the pandemic. But compared to past recoveries, we have seen wages surge higher. And part of this has been some of the labor problems and supply issues on the labor front because of illness and childcare issues and immigration and so on and forth. But all in all, this has been part of the pivot by the Federal Reserve in wanting to shift policy. Besides thinking about raising interest rates, one of the key factors to keep in mind is that the unwind of the Federal Reserve easing stance is just at the beginning. This chart looks at US bank credit growth as a factor that's keeping the central bank policy relative to the shadow rate. And what we do in the shadow rate is we keep in mind both the interest rate of the Federal Reserve, but also the quantitative easing program that they have been conducting for quite some time. And our expectation is that the Federal Reserve will follow through on its guidelines to increase both the shadow to become less accommodative, both as a result of increasing short rates as well as starting to run off its balance sheet. And the offset for the private sector really comes from the bank credit growth, which has started to turn up quite nicely. The expansion of central bank balance sheets is not just a US phenomenon. We know that the central bank balance sheets, as shown here in the dark blue line, have been expanding here at the ECB, at the Bank of Japan, at the Federal Reserve. And then if we add the PBOC, we see that that expansion has been quite dramatic over the course of the last decade or so. We think this is a very important shift that may take place in coming years, which is less use of the central bank balance sheet and is directly a function of what seems to have been a faster recovery out of this recession, as well as the fact that we are actually seeing some inflationary pressure, which has been missing for a long time in the global economy. This is an important aspect to keep in mind for financial markets because volatility has been suppressed for quite some time by the actions of the central banks, and they are starting to get less accommodative. Another thing to keep in mind is the role of the US dollar in the global expansion. Here we are looking at the trade-weighted dollar against the major currencies, and we can see that the trade-weighted dollar tends to have these long cycles where it tends to trend higher. We think it might be finally reaching a point where the dollar starts to move lower for a period of time. We may not be quite at that exact pivot point, but we think over the course of 2022, we might reach a very important inflection point for the dollar. And that matters tremendously because this can be a source of earnings growth for US multinational companies, but also may be suggestive of better growth prospects coming in other parts of the world that have been challenged for some periods of time. So we would say keep an eye out on the dollar over the course of the year, as this could be an important shift in the global economy. One other theme that I really want to talk to you today about is investment spending cycles. This chart looks at total US investment spending going back to over a long period of time. And something that is remarkable about this past recession was that investment spending did not decline by a lot. As we know, the pandemic had a very detrimental impact on many parts of the economy, but because of the shift to the digital economy through the pandemic, investment spending actually held up quite well. Even so, when we look at this total number, it is not stretched at all. And this is suggestive of an economy that has room to continue to see investment spending shift higher. We see two particular factors that are supportive of it. The tight labor markets, which encourage many companies to shift towards automation, but also the infrastructure proposals that were passed late last year and will continue to support investment spending going forward. So this is an area that will have support in the United States. More broadly, across the globe, we think private infrastructure investment has room to continue to be a steady grower. So the top data really shows you the strength of private infrastructure investment over the last several years. And you can see how steady it's been despite the recession that took place. And we can see that in the bottom chart, you can see that this has included both debt and equity in primary markets. So infrastructure investment in our mind continues to be supported by a large number of countries. In Europe, it's the Recovery Fund. Japan has more recently come up with its own plans. And we have also seen in China the efforts for decarbonization getting attention from its government. So this is a theme that we think continues to have legs as we move forward. Another theme that we want to discuss with you is that of supply chains. We talked a lot about supply chains in the context of the higher inflation that's taken root. We think the evolution of supply chains in order to build resiliency will be a theme. And here, there are two goals in particular for companies as well as for governments as we think about supply chains. One is that of diversification, and then the other one is of reducing concentration risks. The end result of this is that we think regional supply chains likely gain momentum, and critical supply onshoring in strategic areas such as healthcare or smart technologies for national security purposes are all part of this mosaic. So keep an eye out on this because we think that this theme will have legs. This just shows you the shift that's ongoing, not just because of all the concerns I mentioned, but also the fact that service supply chains are going to be an increasing focus as we move forward, not just the goods area that has been in the news recently. And that is a shift from a traditional supply chain towards more of a digital supply network. This is somewhat different as we think about the world economy from a futuristic perspective. And the issues that we have to keep in mind are things like data security, privacy issue, taxation, protection of ideas. So there's a lot there that's going on that's worth our consideration. The final theme that I'd like to share with you as we think about the outlook for 2022 is that of climate change. This looks at the history of global temperatures going back to 1880. And I think we all know and have heard of just how incredible the shift has been towards global warming. 18 of the 19 warmest years on record have occurred since 2000. This is an imperative that has finally started to wake up action from governments, from corporations, from consumers. And I think that this will have a lot of impact for all of us for many, many years to come. So I wanted to just share with you a couple of thoughts on the energy transition that is taking place. This looks at the US energy consumption, and this goes back all the way to 1850. And take a look at where the US used to get its consumption from coal, and now take a look at where it's going to get its consumption from renewables. This is a very important switch. We are all experiencing it in small and large ways. And the good news is that the price of renewables has finally come down to levels which is quite attractive and makes this transition really important. However, it is a transition, and ensuring the security of our supply of energy over the next few years is going to be quite important to ensure lack of disruption for the economy as a whole. Decarbonization will require increased commodity consumption. Here we've taken a look at all the different types of metals that are required in the when we are thinking about decarbonization, when we're thinking about wind or solar or energy storage or EVs and so on and forth. And it really speaks to a renaissance for some of the old industries in mining, just as it does towards the new industries which are going to take us into the future. So there's some very exciting opportunities that we see ahead of us as a result of some of what's taking place. So we've gone on a very quick tour around the world. I just want to take a step back and go through some of those main ideas again. We believe that 2022 is the year of normalization. Vaccinations will win the battle over COVID during the course of the year, normalizing growth and inflation as supply chains ease. Europe and Asia, who have been laggards over the course of the last year, get a chance to pick up as activity normalizes. Less accommodative central banks and fiscal policy in the West. Expectations that the weak spot in China is the area where we should think about more easing coming through as the authorities move to stabilize that part of the world. And then some longer term themes to consider, such as the evolution of supply chains, the energy transition, and climate change, as some of the areas that we hope give many opportunities and innovation that will take place for many, many years to come. So I'm happy to answer any questions. I hope that this has been somewhat useful for you, and thank you.
That is a lot of information in a short period of time. And I was sitting there thinking, I probably speak for most of the group, thinking, may the lines on your graphs be much flatter next year. That would be really helpful to everybody, I think, in this room. But thank you so much for that information. And let me introduce our next speaker, David Altig. David's the Executive Vice President and Director of Research at the Federal Reserve Bank in Atlanta. In addition to advising the bank president on monetary policy and related matters, David oversees the bank's research division, which includes the bank's team of economists, the Regional Economic Information Network, and the bank's community and economic development function. Prior to joining the Atlanta Fed, David served as Vice President and Associate Director of Research at the Federal Reserve Bank of Cleveland. He's also published in many prominent economic journals. He's the President of the National Association of Business Economics. So please help me welcome David to the 2022 Business Forecast Luncheon.
Well, thanks for the introduction. I want to thank Mervin and the Walton College for allowing me the opportunity to be here, to be out of the house, and at least for a little bit. This is the first time in 2 years I've put on a tie, and it's about how I remember it. But well worth it to be able to spend this time with you. Mervin was introducing me yesterday as the macro forecaster, which I thought was a pretty generous title. I usually think of myself as a traveling purveyor of woe. And forecaster is a little bit ambitious for the current times. And the statement that sums it up, I think, and has summed it up for quite a while, and Juhi alluded to it, and everyone knows, this comes from the statement of the Federal Open Market Committee on Wednesday. It was also in the statement in December, and in November, and in September, and on and on and on. This always reminds me of the scene in Seven. So if you've seen that, remember that movie, where Morgan Freeman's out in the desert and he sees something horrible. It's Gwyneth Paltrow's disembodied head, if you haven't seen the movie. And he gets on his walkie-talkie and says, Highway Patrol, stand down. John Doe is in charge. And it's felt that way throughout this pandemic that, that COVID is in charge. And we got to do the best we can do, but we have a job. And Juhi referred to the job of the Federal Reserve to achieve maximum employment and inflation at a rate of 2% over the longer run. So I'm going to sort of filter my comments through these two items, which really constitute my day job, or at least my contributions in my day jobs are to these objectives, and think about the economy in those terms. This is probably the spot at which I should say the views that I express are not necessarily those of the Federal Reserve or anybody else with any good sense. So maybe you've heard about this inflation thing that's happening. Here's the picture. Juhi showed this as well. So this is year-over-year inflation using the measure, the Personal Consumption Expenditure Price Index. That is the object of the Federal Reserve's goals. The blue line is headline. The orange line is core. That means subtracting out food and energy components. And we just got a new report on this morning. If you haven't seen it, I will give you the short version of it. This picture didn't, I kind of put the numbers in there, but it didn't change this picture at all. So this is the highest on both of these measures since, I guess, the early 1980s. And quite a contrast from this period of time where we were worrying for like over a decade about inflation being too low. Like many problems, this one seems to have solved itself. What's underneath this statistic is even kind of more interesting or more challenging feeling. One of the things you can do, so if you think about these price indexes, this is a picture coming from the Consumer Price Index, which is more familiar, I think, than the one that the Fed probably focuses on most. You can look at it's just the average of all the prices in some market basket bought by consumers. And so you can look at the components piece by piece to figure out kind of whether, if you see a high inflation number, is it broad-based, is it narrow-based, is it just autos and used cars and, things that we can explain away easily. So this picture says the answer to that is no. This is not narrow. It's not a few items that we can explain away. These price increases are actually quite broad-based. Over 70%, or about 70% now, of the items in the consumer market basket are rising at a rate in excess of 3%. And if we look at those rising in excess of 5%, that's almost half. So you've got to go back into the 70s to kind of see numbers like this. It's actually quite startling. Now, that's now. What's tomorrow? This is about kind of looking forward. So what's tomorrow going to bring? And I want to kind of harken back to that core CPI measure I showed a couple slides back, along with the headline measure. The headline measure is the one that actually matters in the longer term. That's sort of the goal of the Federal Reserve. And so you might wonder why we throw core in there, and some people have facetiously suggested to me it must be that economists don't consume food or energy, so they like to talk about that one. I always present myself as Exhibit A. I clearly am consuming food. And it's a pretty safe bet I'm not walking long distances to get it. So the point of that measure is it cuts out some of the noise in the statistic and hopefully then gives us a better idea of where inflation is heading after we get over the bumps. But it's not the only measure that we might think about. So at the Atlanta Fed, we actually, and Juhi actually kind of talked about a couple of these statistics, we have a whole bunch of statistics that are basically different cuts of these consumer price indexes that are useful for forecasting in one way or another. Some of them they have different advantages and disadvantages. Some of them are better than others. But we sort of want to take a big portfolio look at where we think are heading. And for convenience, we color code these things. So our color code is basically if a statistic is flashing green, we're kind of right on target. If a statistic is flashing a cool color, purple or blue, then we're below target. And if it's flashing a hot number, we're missing to the high side. Everything's hot. Any way we cut kind of this look at the statistics, it's telling us, you're missing. And because these are somewhat forward-looking, they kind of send a message that, this is not just a one-shot deal. Now, this picture is a little bit unfair to those of us who are in the monetary policy business because it's a 12-month inflation growth rate. We're kind of just looking what's happened over the past year. And the committee has been very clear and has been super clear since about August of 2020 when they announced, look, we want you to know how we're really thinking about hitting our goal on inflation. And we're thinking about it as something that is over the longer run and a situation where we're averaging 2% over time. So if we have there's some explicit language in this actually in their statement about this. If we've missed to the downside for a long period of time, then it's okay with us if we miss to the upside for some period of time to kind of be able to look back and said over this window, however long it is, we hit 2% because that's what we want to do. We want to hit it on average. And of course, for the period between about 2012 and up to the beginning of the pandemic, we consistently missed in the United States inflation to the downside. It ran soft to 2%. So are we just making up lost ground and are we right on track with the target? And the answer is, yeah, kind of. If you grade on a curve, maybe. There's some green in here, but there's also some hot numbers. And this is in this sort of dashboard look at things. And this is really sort of imperative if we do an exercise that we actually like to do in Atlanta. Say, well, what does over time mean? The committee has not particularly said what the longer run is, but we said, well, okay, 5 years seems kind of reasonable. So these are 5-year averages of the rate of inflation looking backwards. And you can see that long period in between 2010 really and right before the pandemic where we hit to the low side consistently, but now we're quite a bit above this reasonable definition, I think. Again, I want to be clear, it's not the committee's definition because they haven't written down this as a committee and said it's 5 years is what we're looking at. But if you thought of something like 5 years as a sensible average, we've gone from underperforming relative to the target to overperforming seems like a bad word, but missing to the high side for sure. And this is very definitely on the attention, getting the attention of the committee. So this is basically from testimony that Chair Powell gave a couple weeks back, who said, yeah, we're looking at these numbers and we see what you see, they're high. And, even if we kind of think of things in a longer term context, they seem high, and we don't want that to persist into the future. If these high levels of inflation get entrenched into the economy and people's thinking, then inevitably that will lead to problems that we are going to have to confront, and confronting those could well be very, very painful. So the chair has been as clear as he could possibly be that we see it. We do not think at this point that it's something we can dismiss, and monetary policy is going to be calibrated going forward accordingly. Now, juxtapose that with the other objective, maximum employment. This is from Wednesday, the press conference that the chair gave. And he said, look, I think if we look at labor markets look like they're pretty much back to normal, whatever normal might be. Or that, to put it a different way, what is normal for the moment in any event in a COVID world that has not really completely become a non-COVID world. So you know what we're looking at and what you can look at. This is the unemployment rate, which is fallen well off of its early pandemic peak and is back really to levels consistent with where we were at prior to the pandemic. If we look at employment, the story gets a little bit trickier. So this is basically a picture of the share of jobs that were lost as a result of the pandemic that have been recovered. So 100% is full recovery. We got all the jobs back. And I've cut it by different sectors here. So the total is the far left bar. The colors just represent different segments of months since the pandemic started. And what you see is that really no broad sector in the economy has fully recovered the jobs lost during the pandemic. So it's reasonable for you to ask, I can see you out there asking me, well, why are you going to declare maximum employment? Why are you going to declare victory on your maximum employment objective when you haven't recovered all of the jobs that you lost during the pandemic? My answer is that we actually don't expect that those jobs would be recovered, even in a fully functioning labor market. Whoops. So this right-hand panel here, I think, is a really startling picture. You may have seen something like it somewhere. It is the normalized ratio of hires by businesses to the number of vacancies or job postings by businesses. So if you look back kind of in 2010 there, in the early phases of the recovery from the financial crisis, there were a lot less vacancies than people getting hired. Now we're off the chart, quite frankly, as far back as we have been able to collect this data, which is not that far, but as far back as we can collect this data, 4.5 million more vacancies than hires. It means the jobs are there, they can't be filled. And an explanation for this, Juhi was referring to as well. This is the size of the labor force. That means people age 16 and up who are either employed or officially unemployed. And you can see the big drop associated with the pandemic. And then the kind of the rapid kind of jump up to a somewhat higher level, but then not much progress since. So the question is, should we expect to get back up to that trend line? And should we only declare victory on a labor market becoming functional, at least as functional as it can be in current circumstances, if we're not up to that trend line? And I think the answer to that for me is that's questionable. So here's the labor force participation rate, the fraction of the population that is looking for a job actively or has a job. And I've given you two different measures here. One is the overall labor force participation rate, that's everyone, and the other is the prime age labor force participation rate, so people aged 24 to 55. So if you look at the orange line, it's not back to its pre-pandemic peak, but its pre-pandemic peak was very high, and it's sort of back to kind of what looks normal in the context of what it would look like before COVID hit. If you look at overall, though, it doesn't look anything like that. It looks like the picture I just showed you a second ago, which looks like no progress, hardly at all. I think the answer is, in many ways, in this picture. So this is that labor force participation picture I just showed you, although I've given you an estimate with the dashed line of what we would expect it to be if we accounted for retirements And in particular, what we would expect it to be if we factor in to our look at labor force participation, the aging of us baby boomers. So that line is literally constructed by taking kind of the people who are just on the cusp of retirement in 2019, and then asking, well, what would labor force participation rate look like if these people retired at the same rates as the people were of their age were retiring in 2019? And you get rid of at least half of the shortfall in labor force participation as a result of doing that. There is another factor that is not readily amenable to just improving economic conditions, and that is basically foreign workers. So again, you see the working age foreign-born population kind of growing on a pretty steady trend line up to the pandemic period. Then you see the drop-off and kind of really no recovery yet. I'll leave this as an open question. You think that's coming back anytime soon? And I'll add one more thing. The work of one of my colleagues who has studied employment loss during the pandemic has looked at the question of which group of people were most impacted with employment loss and have been the slowest to recover as we've gone through the pandemic. And the answer is disproportionately single mothers with children under the age of 6. So this problem in this picture having to do with immigration, and by the way, I credit Juhi for showing me a picture like this for the first, that's really when it got on my radar. Is this going to turn around soon? Is the problem with reliable childcare, with opportunities to enter the labor market with young children changing soon? It may change as COVID conditions develop for the better. But when I made the comment earlier, are we kind of maximizing what's possible now, given the set of circumstances the economy is facing that are not about not having enough spending or not having enough demand in the economy? I think that probably these pictures suggest that we are. All right, so just to conclude here, you know, I don't want to give a number, for goodness sakes, but let's say kind of my baseline view of things is something like GDP growth remaining above normal for this year. Normal being the 2% all you guys wrote down apparently last year. It's a pretty good guess if you're just guessing the steady state of the economy, but I think we're not there yet. So let me write down something, you know, between 2 and 3, and let me write down the same number for inflation. So inflation staying somewhat elevated relative to the 2% target, but actually kind of fading back towards the 2% objective as we move out of this year and into next year. Now, what will cause this to go awry? Well, there's a real issue with wages. It has to do with the tightness of the labor market that I was just talking about, and the fact that the labor market really has not adjusted, employers have really not adjusted to the simultaneous reality of a tight labor market and high inflation. So I'm showing you two pictures here. One is just wages in dollars, that's the orange line, but once you adjust for inflation, you get the blue line. Wages in the economy adjusted for inflation are not growing and have not been growing. And that, given the fact that there are, 4.5 million or whatever the number was, vacancies over hires, suggests that this picture is not going to persist. So as wages catch up, what is that going to do to the inflation outlook? That is a real wild card. There's the supply chain stuff. When I said, when I gave you those kind of not numbers a minute ago, that kind of viewpoint is predicated on the belief that global supply chain disruptions and dislocations are going to abate as we get into the latter part of the year and again into next year. And then finally, Chair Powell's comments about inflation expectations. These are a couple of different measures of longer-term inflation expectations from surveys, basically. And you can see them ticking up, but it doesn't look all that dramatic. If this game is lost, then the game is really going to be very much different. So if I have the opportunity to talk to you again sometime in the future, and someone is unkind and rude enough, quite frankly, to point out how wrong I was with everything, I'm pretty sure I'll be pointing to one of these things. Thanks very much.
Thanks, David. Again, a ton of information in 20 minutes, and I have to admit, and I probably speak for the whole group, I did not plan to laugh today. That was not what I was expecting coming to this lunch. No offense to Dean Waller or this event. I just wasn't expecting to laugh about anything related to the economy, but you got us there, so thank you. And now, Mervin, that's the bar. Laughter is the bar for the afternoon. So it's now my pleasure to introduce Mervin Jebaraj. Mervin's the director of the Center for Business and Economic Research. He's an exceptional source of business and economics-related expertise that journalists and business people alike use to understand how national and regional issues impact Arkansas and Northwest Arkansas. Mervin's a member of the board of directors of the National Association of Business Economics. So please help me welcome Mervin.
Man, I don't know about the pressure to make jokes here, but let's see what I can pull off. If it comes off the cuff and it's not good, just politely laugh anyway. For those of you that didn't sleep through my Zoom presentation on business forecast last year, you'll notice that the title of my presentation hasn't changed. It still says Arkansas Economy in the Time of COVID. I did add a subtitle, though. This is the song that never ends, because it goes on and on, my friends, because people keep spreading the dang. Yeah, anyway. So I do want to remind you that there are green cards on your tables. If you have questions, we're very happy to take those questions from you. So someone will come around and collect them at the end of my presentation. I do have good news in this presentation somehow, even though we're in the midst of all of that's going on. And I'll start with good news. So this is a forecast, sorry, not a forecast, this is actually what happened in the Arkansas economy in 2021. And going back all the way to the previous recession that was in 2007 to 2009, you can see that, 2021 was a stellar year. We had added 27,000 jobs in the Arkansas economy. That's not a number that we'd hit in a very long time. In fact, the last hot economy we had in Arkansas was in 2015 and 2016. At that time, we had just added about a little north of 20,000 jobs and a little south of 20,000 jobs. So 27,000 jobs and a 2.2% growth rate is not a rate that we've hit in a very long time in the Arkansas economy. So that piece of good news, however, is a little bit, or not a little bit, but pretty much very out of context because, we added 27,000 jobs in 2021, but we lost 38,000 jobs in 2020. So even at this early in the morning, or I guess afternoon, you can do that math, we're still down about 11,000 or so jobs in Arkansas. So that's just looking at where we were in 2019, not thinking about what we could have had in 2020 and 2021 if there was no pandemic. So I think, I'd look back to my forecast, which was obviously wrong because I didn't predict a pandemic. But we were expecting 20,000 or so jobs to be added between 2020 and 2021. So, so far we've lost 11,000 jobs, and we've also missed out on, hopefully if my forecast was right, about 20,000 jobs that we would have added in that time period. And if we look at which sectors added jobs in 2020 and in 2021, you'll see that professional business services right on top. About a fourth of those jobs came from Northwest Arkansas. Leisure and hospitality was one of the strongest gainers in last year, but that's largely because we lost a lot of jobs in this sector in 2020, and this is mostly trying to get those jobs back. And we didn't really, make all of those jobs back, so we added about 5,700 or so jobs in that particular sector. Manufacturing added about 6,000 jobs, and then most of those sectors had a few thousand jobs until you get to the bottom there where you see the negative numbers, and at the very bottom you look at government and it says we lost about 4,000 jobs in that sector. And before we pat ourselves on the back and say, well, this is a great job, we reduced the size of government, I would like to point out that most of those jobs are in your school districts, and it's really indicative of the fact that schools are not functioning at full capacity, not that, we've somehow magically reduced the size of government. We just don't have as many people in schools as we did in 2019 or years before that. For those of you that missed my Zoom presentations, my wonderful Zoom background, which is rated 9 out of 10 on RoomRater, you will know that when I do my forecasts, I don't use a crystal ball, but I do use those crystal decanters in the back. I know some of you have tried to follow the levels of the decanter to try to figure out where my forecast is going. Those levels look pretty low, but let's not make that about the forecast. Let's just put that down to supply chain issues as well. My forecast is, generally positive, maybe a little bit tepid, but I am thinking about 20,000 jobs statewide, net increase in 2022 compared to where we were in 2021. Does that get us above where we were in 2019? Yes, but not a whole lot more than where we were in 2019. So there are a couple of reasons why my forecast is a little bit tepid. Both of them are very much related to the pandemic, in as much as that I don't think that the pandemic is going to be completely gone in 2022. I think we're going to be dealing with this in some form or the other through the rest of this calendar year. And as a result, it affects two things. In the previous 2 years that we've had the pandemic, we had incredible stimulus from the federal government. The federal government's largesse was quite incredible in a low-cost state like Arkansas. So if you think back all the way back to 2020, there were $1,200 checks sent to every household, and then follow that up with a $600 check, and then a $1,400 check. There was a $600 a week boost in unemployment benefits, then a $300 a week boost in unemployment benefits, and then for a lot of last year, households also got $300 in child care tax credits or child tax credits. So if you were an average family of 4 in Arkansas, and say you never lost your job, so you were not on unemployment, so I'm not even counting those benefits, between April of 2020 and by the time you file taxes this year, the federal government would have sent you about $14,000 between that time, which is an incredible sum of money that the federal government has never done in response to a recession before, send money that way to households. So when we had the pandemic in 2020 and 2021, there was a lot more money flowing through the economy. At this point, it looks like no other bills are, have any high prospects of being passed. So it looks like the federal stimulus is cut off, even though we're going to be dealing with some low level of the pandemic all of this year. And the second reason my forecast is a little bit tepid is to show you where we still have to gain jobs. So if you look at the bottom of this chart, you'll see those sectors that we lost jobs in, particularly leisure and hospitality and healthcare services in Arkansas. Both of those in the decade previous were the fastest growing sectors in Arkansas, healthcare and leisure and hospitality. And there's still quite a few jobs out in those two sectors. So, until we get those jobs back in those particular sectors, about 8,000 or so jobs in leisure and hospitality, about 5,000 jobs in healthcare, and there's about 7,000 jobs out in the government sector as well. So that's school districts across the state, largely school districts across the state. Until we get those jobs back, it's going to be hard for us to get back to a level of, level where we were in 2019 and beyond. The one sector on top that says other services, this was hard hit by the pandemic initially. These are laundromats, personal care services like hair salons, nail salons. Clearly, they're doing a lot better. So people are more comfortable going to those services than they are at leisure and hospitality businesses. So for those two reasons, my forecast is a little bit more tepid than it would be. Now, we've tried to follow along what's going on with small businesses in Arkansas. This is a survey that is conducted pretty often, actually, so it gives us very good long data on how businesses are doing, and you ask them how they feel about the pandemic. You'll see that about 21% say they have a very strong negative impact, about 40% of small businesses saying a moderate negative impact. Both those numbers obviously went up as a result of everything that's going on with Omicron. And you ask these same people how long they expect this to persist, they say around 4 to 6 months. So again, that's another factor for why we don't think that we're going to get all of those jobs and then some in Arkansas anytime soon. I do want to talk about labor supply. Start with looking at the unemployment rate. The unemployment rate for 2021 ended up at 4% in Arkansas, which is not quite the record low. On an annual basis, that was about 3.5% before the pandemic. The December unemployment rate was 3.1%, which is actually the record low, unless they revised that up, which is entirely possible. But this record low unemployment rate, carries over through all of our metro areas in Arkansas. I have the 6 up here. You'll see that almost every one of those lines is lower than that line has ever been that we have data for. At the very bottom is the lowest unemployment rate here in Northwest Arkansas, 1.5%, which is the record low. We've never hit that number before. And the very top is Pine Bluff, which is 3.5%, which is, again, the record low in Pine Bluff as well. So does this mean that, everything's back to normal? Clearly not. As, previous speakers have alluded to, there are clearly a lot of people still out of the labor force, and your prospects of whether they come back or not really does determine whether or not these record low unemployment rates are actual or if there's people out of the labor force. So this is a variation of the chart that David showed. This is the employment population ratio for the US and Arkansas. You'll see that the Arkansas employment population ratio is about 1.5% or so behind where it used to be in 2019. Do we think this is coming back? What happened to the labor supply, at least in Arkansas? So there's been a lot of speculation about why people are not working. Did they become TikTok influencers or YouTube stars? We don't know. Did they take Dogecoin to the moon? Well, if they did, they certainly crash landed last year. AMC, GameStop, did this make people a lot of money? Sure, it made some people a lot of money, but if you've seen the stock market performance in the last week, if somebody quit their job or AMC and GameStop stock, they're probably looking for work right now. And maybe they become NFT connoisseurs. They're great connoisseurs of bored panda art or bored ape art, whatever that thing is called, which seems to be 2022's equivalent of trading baseball cards. But I don't know that there's maybe tens of people in the state that have quit their jobs to do these things. So there's not, a significant number of people. So really where we think these jobs are, and David mentioned this, is retirements. A lot of people retired. The retirement rate in 2020 and 2021 actually went a little bit faster than we were expecting. So more people retired in those 2 years than we would have normally expected to retire. Will some of these people come back to the labor force when the pandemic is over? Some, but not all. A big issue tends to be childcare. This was an issue in Arkansas before the pandemic. So when I was up here in I guess it was January 2020, I was talking about how again, what David mentioned, women, especially with children under the age of 6, so not school-aged children yet, are out of the labor force in a higher proportion because childcare costs were expensive. So that problem continues in 2020, in 2021, and 2022. The only difference is it's gotten worse in the sense that childcare facilities are closing, so it's not just expense anymore. They're just not open because they don't have enough staff or their staff are sick. And then school-age children that are fairly young are at home more often too because schools are closing because, again, they don't have enough staff or they're quarantining or isolating. And as a result, a lot more parents are not in the workforce because they're taking care of taking care of kids that are either pre-K or even supposed to be in school. And so this was a study from the Chamber of Commerce, the U.S. Chamber of Commerce, along with the Arkansas State Chamber of Commerce. And it shows you, how many people are not working full-time, how many people are not able to hold on to a job because of childcare issues in the last year. And they estimated that, the cost to Arkansas businesses and the state was about $865 million. The other reason people are really not working is, as it turns out, they're, getting sick or taking care of somebody that's sick. So between beginning of December and beginning of January in Arkansas, there's 47% more people not working because they're either sick with COVID or they're taking care of someone that's sick with COVID. And the green bars show you the people that are not working because they're afraid of getting sick or spreading the disease, and that has gone up 31% in just that 1 month. So again, this number tends to move up when there's a new variant and a big surge in cases and then eventually tapers back off. But occasionally this level of disruption in the labor force is why we continue to see labor supply problems. So As with any good economist, I have to give you supply-side issues and then demand-side issues. When we ask small businesses, are you having trouble hiring workers? Answer is usually yes. About 32% say yes. That number is higher now, again, because of the Omicron variant than it was, but has steadily been above 20% throughout the entire time that we have data for. And there are two reasons that I'd like to point out. We looked at a chart like this for the national level that shows the number of job openings, the number of hires, and the quit rate. In Arkansas, there are currently about 10,000 or so job openings and 6,400 hires, so there's quite a few jobs not being filled. But I want to talk about that line, that's the third line from the top, which says 4,000. That's how many people are quitting, and this is data from November of 2021. This is the last that we had data for. 4,000 people quit. That's actually down 1,000 from 5,000, which it was in the fall, where it reached a high. That's 5,000 people quitting in 1 month. What are these people doing? As I've mentioned, they're not TikTok influencers. As it turns out, people are quitting small businesses and taking jobs at larger businesses, because larger businesses obviously can afford higher pay, better benefits, better flexibility in work schedules, and so on and so forth. We see a lot of people quitting smaller businesses and heading to larger businesses. So that affects small businesses' ability to hire. But the other big factor is, and I'm not going to complain about this chart in any sense. In fact, we should celebrate it. This is the number of new business applications in Arkansas, and you can see the number of new business applications in Arkansas has gone up an incredible amount. So in 2020, it went up about 30%. In 2021, it went up again about 30% in Arkansas. So the pandemic started, federal government sends $14,000 to households in Arkansas, builds a temporary social welfare state, and all of a sudden people are willing to take a risk, step out of their job, and start their own business. What does this mean for existing employers? They're competing with all these new businesses in hiring workers. Those two lines that you see at the bottom are subsets of that line on top, the blue line. Those are businesses that either have payroll attached to them when they file the business application, or they're very likely to have payroll attached to them when they file the business application. So it's not just some person with a hot dog cart and that's the only employment. It's actually businesses that go out and hire other people. So on the demand side, people are quitting small businesses, going to large businesses. Also, people are just quitting and starting their own businesses and then trying to hire people. So if this persists, this is good, but that means that we will have an elevated demand for labor in the state. But we're certainly not going to complain about people being more entrepreneurial. I do want to talk about what's going on employment-wise in some of the metro areas across our state. So we start with the largest metro area, Little Rock in central Arkansas. You can see that last year they added about 4,300 jobs on a year-over-year basis, and they're still down about 13,000 jobs between 2019 and 2021. You can see which sectors have added jobs. Not a whole lot of jobs. Most of those sectors are actually fairly negative at this point. You see healthcare being positive up in the central Arkansas economy, but I would like to point out that it's probably temporary hires. Obviously, hospitals have gone out and hired a lot more workers to deal with the surge in the pandemic, so most of those jobs may not stick around for a long time. But you look down towards the bottom, you'll see that leisure and hospitality still has a lot of jobs left to recover. Manufacturing has a lot of jobs left to recover, professional business services, and that government sector is also negative. Again, half of those jobs are in the local level, so school districts, but another half of those jobs are, again, temporary hires of the pandemic, so the state had gone out and hired contact tracers and those types of jobs, and most of those contracts have gone away at this point. And then here in Northwest Arkansas, the second largest metro area in our state, you'll see that in 2021, we added about 13,000 jobs. It was fairly spectacular. Between 2019 and 2021, we're actually 11,000 jobs higher than where we were in 2019. So this is the only place this is true for in all of Arkansas. We have more jobs in Northwest Arkansas today than we had in 2019, and no other metro areas in the state has done that yet. Now, is this great? Absolutely. Would we had even more jobs than this had we not had the pandemic? Probably. We probably would have had 16 or so thousand jobs instead of losing jobs last year between those 2 years. So when we look at which sectors are doing well, obviously leisure and hospitality sector did the best. Leisure and hospitality sector in Northwest Arkansas had a rough 2 years. And when I say rough 2 years, this is 2021's data. I'm talking about 2020 and 2019. 2020 is obvious to everybody. It was the pandemic. But 2019 in Northwest Arkansas was pretty rough for leisure and hospitality too, and that was largely because of Chad Morris. There's no love lost here, is there? Construction's done well in 2021. Information has done, information sector, obviously not a whole lot of jobs there, but that's done well. Our usual stars, professional business services and trade, transportation, utilities, would have been a lot higher. But, leisure and hospitality is leading the top because we did lose a lot of jobs in that particular sector. Healthcare, a lot higher, so it's not just temporary hires. Some of these are going to stick around permanently, and we've added jobs both in government, all the way down to local government level, manufacturing, and financial activities. So how do we compare from 2019? Oops, skipped one. Well, how do we compare from 2019? I guess I might have just skipped that chart entirely. In Northwest Arkansas, the only sector that does not have more jobs in 2021 than in Northwest Arkansas, 2021 to 2019 is the leisure and hospitality sector. Every other sector, construction, manufacturing, professional businesses, all of those sectors have more jobs today than we had in 2019. So leisure and hospitality sector is still out about 600 jobs. Again, we're going to blame Chad Morris for that, and it's really the pandemic, unless Chad Morris is responsible for the pandemic too. Around the rest of the metro areas in Arkansas, you'll see that Fort Smith added about 2,300 jobs in the last year, but they're still down about 2,000 jobs. They're missing jobs in manufacturing, which is a very important sector for Fort Smith, in the government sector, and healthcare services. At the bottom right corner, you see Jonesboro. They added about 1,500 jobs last year, and they're only down about 400 jobs from 2019, so doing a lot better than most of the other metro areas, with the exception of Northwest Arkansas. And then Hot Springs is up 800 jobs, still down about 1,000. Obviously, the leisure and hospitality industry is very important to Hot Springs. Conferences are happening, people are gathering, as evidenced by all of you here. But business travel and conferences really haven't picked up. They did start picking back up last year, and then we've had the Omicron variant, so there are a lot more cancellations again. So until we get to some semblance of normalcy there in business travel and conferences, Hot Springs is going to have a hard time recovering those jobs. And then finally, the Pine Bluff metro area, you see that they added about only 400 jobs last year, so they're still down about 1,000 jobs. And I think that, again, we've had some potential for Pine Bluff to grow their employment with investments in their casino and their leisure and hospitality sector. But again, that tends to be heavily affected by the pandemic, so we're going to have to wait to see some of those jobs. So that brings me to the end of my presentation. Generally a positive outlook for the state as a whole. We're going to add about 20,000 jobs, we think. Hopefully there's not another variant and another surge, but if there is, I guess don't throw away those masks just yet. And if you have your questions, please hold them up in your green card. Someone will be around to pick them up, and we'll take your questions.
Thanks, Merv. Appreciate it. I think you took us to a new level there. We might be able to take this show on the road. I was thinking maybe not, Auburn might not be the place we go to, but after some of your latter comments. If you do have questions, as Mervin said, let's get those up here to us. I have a lot of questions, and I wrote down several more as we got started. But Mervin, let me start with you, something that's specific, not specific just to this area, and David, maybe you can comment as well. Supply chain impact on growth. So supply chain and what's going on in the world. We see it at Walmart, the technology, the futuristic look at what supply chain is going to be in the future is a big part of what we're going to do. And it's a big part of this area with J.B. Hunt, Tyson, Walmart, and University of Arkansas being the #1 supply chain school. I'll get that in there for the University of Arkansas. How do you see that impacting the growth of this area? And then David, I may have you comment on how you see supply chain. Is that an upside potentially to the national economy?
Yeah, I mean, I think, supply chain is one of those things that it's not at the forefront of consumers' minds. It's behind the scenes. People don't really think about it, but everybody's been forced to think about that.
They are now, right?
Yeah. People probably didn't even use the term supply chain a whole lot in their normal lives, but like that's all we've talked about in the last year. So I think that's, for this region anyway, being a leader in the supply chain area, I think that's probably a good thing. We'll continue to innovate, develop new ways of bringing products to our markets. And I think, some of these long-term issues that you've seen in supply chain that are starting in global, on the global end of the supply chain could end up meaning that you end up with some manufacturing jobs here in the United States as a result of, some of these issues that we've had with getting chips or whatever. It's not going to happen anytime soon. Nobody's going to be able to build a chip factory here next year. But I think over time we could see more of those types of jobs ending up in Arkansas and all over the United States, just as a result of having had these delays. Maybe people holding more inventories in the future.
Yeah. So this supply chain issue is a double-edged story, I think, for the next couple of years. On the one hand, just sort of the easing of some of the acute pressures that we've seen is going to be helpful. And it will be kind of help to support growth. It'll help to kind of moderate inflation. But on the other hand, this event has, and there are probably lots of people in this room who know more about this than I do. So in many ways, I'm channeling feedback from our business contacts, but once bitten, twice shy. And I think there's been a global lesson that what we thought was a cheap means of organizing production by kind of decentralizing across the world, when it hits the fan, it's not so cheap. So there is going to be a reconfiguration of some sort, and one that will, on average, look more costly. And that is, and that's going to move sort of in the other direction. These structural adjustments tend to be a bit of a drag on growth. Higher cost pressures could well be in play. And it's going to be kind of a race over the next couple of years to see, I think, how, which one of those forces becomes dominant.
Yeah, there's so many. When I was thinking about Juhi's charts again and all of the ups and downs, and there's so many levers that are at play, some working together, some are working against each other, and I think the first half of the year we'll see some of those things play out in real time. Juhi, I'm going to come back to you. Thanks for joining us remotely. There's a lot going on from a geopolitical standpoint, and we all watch the news and hear things that are going on in different parts of the world. What are the couple that give you the most pause as you think about the U.S.? Let's talk about the U.S. economy specifically. What are the ones that give you the most pause as far as potential impacts on our economy the next 2 or 3 years?
Thanks so much for hosting this discussion. And again, thank you to the University of Arkansas one more time for your kind invitation and your flexibility in having me do this remotely. Honestly, I would have loved to be there with you, breaking food together rather than doing this this way. On the geopolitical front, two in particular that I would highlight. One is really watching the price of energy. So this conflict, for instance, what's going on in terms of Russia and Ukraine, but also more generally the energy transition and finding security in energy supplies in Europe, elsewhere. That's really, really important to ensure that we don't suffer from a spike in commodity prices, because that is very much an Achilles heel for the US consumer if there's a surge in those prices. And then the second one I would say strategically is China. China and US relationship has been on a deteriorating path for quite some time. We started with supply chains. I think the strategic imperative now that we're seeing with the CHIPS Act that is going through Congress right now seems directly in relation to that, and thinking about shoring up technology for the future and allowing for the US to maintain its competitive edge. And I think just having these relationships stay smooth and not have more turbulence around them is important for sustaining the global recoveries around the world.
David, you talked a lot about China. There's probably, you know, the two countries are so interlinked, maybe more than other countries have been in the past. How would you answer that same question about China and the things that are going on there and the potential impacts on our economy?
Well, a lot less articulately than Juhi did, because, I mean, the three of us have lots of opportunities to listen to people who really know a lot about China and who have been embedded for quite a while, and they can't figure out what's going on. The situation has become so opaque that it's really almost impossible to get a bead on what the trajectory looks like. The big, immediate concern has to do with, the policies that they will follow with the current wave and potential successive waves of COVID, and whether or not that will disrupt some of this adjustment back to normal and supply chains and those sorts of things. But I think kind of the longer term stuff that Juhi is sort of alluding to is not only first order, but also completely almost impossible to kind of figure out how it's going to play out. You almost have much better sight lines into what will happen if the Ukraine blows up than you do with what normal operating procedure will be in China.
That makes sense. I'm going to completely change topics. One of the things that's been discussed, I think particularly in the last couple of years, I know as a company we talk a lot about it, and that comes in the form of, I'd say, economic mobility. And as the economy has gone through what it's gone through the last year, in 2022, maybe we end up back in more of a normal type environment. How do we ensure that everybody participates? Whether race, economic status, one of the great things about, particularly in the United States, has been the ability for everybody to participate. And how do you feel like, as whether it's Northwest Arkansas or the country, that we can do a better job of that? Maybe starting with Mervin.
Yeah, one of the things that comes to mind immediately is, something that we've talked about a lot in the last year, and we have invested a lot of resources, is housing affordability in Northwest Arkansas. So I didn't put up a chart of the population changes in Arkansas during my presentation, but if we have 75 counties, only about 20 counties added people in the last 10 years, and really only 14 or so counties added people outside of the margin of error in the census estimates. And the two fastest growing counties, obviously, Benton County and Washington County, and then some distance behind is Craighead County and Saline County. But if you look at the people moving to Northwest Arkansas, about more than 40% of them are coming from other parts of our state. And when we talk about economic mobility, the kind of thing that used to happen in the 60s and 70s is, there was a great equalization of jobs across the country, where if certain states had better job prospects, if you were in just the services economy, if you were a hairdresser or a plumber or an electrician, you could make more money going to California and getting jobs there, and you were fine. And so, like, states had equalized, their median incomes, or were on that path. Over time, we haven't built enough housing, and that same is true here in Northwest Arkansas. It is very expensive to buy a house in Northwest Arkansas if you're coming from other parts of the state, and even other parts immediately around us. So we have a lot of economic opportunity here. We want people to be able to take that opportunity. If they're in a part of the state or a region that's not performing well, they can come take jobs here, but very often they can't afford the rent or to buy a house here. And so that's an important challenge that obviously we've taken a lot of steps to try to address, but we're behind the ball at this point. We really need to catch up.
David, I'm guessing you and Juhi have thoughts on that as well, because it's a global issue.
Yeah, I'm so glad you asked that question. So I want to one point I want to make is that we've become sort of more sensitized or feel a heightened sense of urgency as a result of COVID to these economic mobility questions, and then obviously some of the social disruptions that sort of have surrounded the period. But I like to remind people that during the financial crisis, the sector of the economy that took the largest hit by far in employment was manufacturing, and those jobs never came back. They disappeared. So we came into this pandemic with, and in fact, low skill or low wage jobs actually grew through the financial crisis. So we came into this pandemic with an unresolved problem that was over a decade old, and then we added a new one. And so the time is well past to get our arms around it. At the Atlanta Fed, one of the things that we've been focused on is the interaction of workforce development efforts with public assistance programs and the very severe disincentives for people to skill up and participate in workforce development as a result of what we call benefit cliffs, the sort of phasing out of public assistance if you earn another $1,000 or $2,000 or whatever it is. And we've been able to show through analysis that we've done that in many cases, sort of the proposition of moving from a minimum wage job to a certified nursing assistant or a licensed practical nurse maybe even, those gains can completely be wiped out for a family by the loss of food assistance or medical insurance assistance and so on. So I'm very happy. I was telling Mervin this last night that last week I signed a memorandum of understanding with the mayor's office of Fayetteville, where we will be coordinating with workforce developments in Fayetteville and providing some of this analysis to help try to really think through what needs to be done and addressed if these well-intentioned and appropriate efforts to bring people up into the economic structure through training, education, experience, make sure they're not being mitigated by the unforeseen circumstances of the real reality of where people are living.
Yeah, that's great. Juhi, you have any thoughts?
I have three things I want to share, and they really just build on the things that Mervin and Dave put out there. So hopefully I can be really quick about them. The first is if I think about what Mervin said about the cost of housing, and I think about all of our collective concerns about inflation, I think these two areas, housing and education, they are going to be two areas that I would bet we are going to see more reform in the next 5 years than we have seen in the last 25 years. That's my personal bet. It's not a forecast that, it's the kind of forecast you're going to remember and then have me say, well, what kind of forecasting do you do? But I really think the tide has turned in having a scrutiny on some of the highest pieces of the budget for consumers, especially in this country. And I think that we will see some change there. The second one is there's really a difference this time around relative to where we are coming from. And that is that I think the problem that companies and most folks over the next 5 to 10 years are going to face is that of shortage of labor. And that is very different than the surplus of labor that came out of the last crisis. So I think that there will be a natural tendency for the cost of labor to go higher, which will be more inclusive for many, many more people than when it was that asset prices were leading the charge. And then the third thing that I would mention is that when I think about all the government programs that Mervin talked about and reminded us of, there is one that I actually have championed, and that's the physical infrastructure proposal, which I am quite pleased about because I think it has the opportunity to bring back blue-collar jobs into the United States in a way that has been missing for a long period of time. And that will have a fantastic multiplier effect over time. So I think the problems are real. I don't think they're going away, but I actually think the tide is turning with some of these things as we go forward.
Yeah, that's great. It's a really important area, and as we grow as an area, as the country continues to grow, these are important topics that we're all going to need to continue to focus and make sure that we're doing the right thing around these topics. I'm going to switch one more time, and I'm a little nerdy actually when it comes to employment and unemployment. I have an economics minor, which makes me like super dangerous in what I think sometimes. But this labor participation rate is something I've been watching very carefully over the last couple of years, because as you mentioned, if unemployment's so low, why we have so many people, why we have so many jobs open, if unemployment rate's so low. And you've seen economies that have aged. I think about economies like Japan, where I've spent quite a bit of my career in Japan. You see them age, and that labor participation rate becomes a challenge to productivity. If you think about whether it's the U.S. government or businesses, what are key ways in which they can help with that and keep that participation rate elevated? You obviously have aging, you have boomers aging, but is there a way, are there things we can do that are different than what we're doing today to keep that rate higher than it might be otherwise?
Well, I really only have the most trite response to that, which is we know that there is a fairly sizable population of people who are underemployed. And some of that means underemployed means not employed and should be, who are facing all of the impediments that had been discussed before, adequate childcare, adequate housing in the places where jobs are, and look, I mean, I'm going for I hate to kind of inform everyone, but I've experienced in my own life this aging thing doesn't reverse. So it, you know,
My gray hair agrees with
we're
you.
kind of stuck there. Immigration, and if you want to do it the old-fashioned way and kind of get the population up, that takes 20 years or so for that to come to fruition. So immigration is a natural, but those aren't waters I wade into. It's not part of my portfolio. But I don't sense a kind of great movement for solving the problem that way. So it's to look to our own folks and find out where the hurdles are and bust them down. I mean, it really doesn't get as hard it's as hard and as simple as it sounds.
Yeah, I mean, I think if you look at immigration levels, that you had that chart up, there's huge decline in immigration in the last several years, and especially in the last 2 years, because even if you have valid visas or claims to come to the United States, embassies have been closed around the world, and so people just can't get visas to get here, and so that will eventually resolve the backlog, but not enough to deal with some of the population losses that we've seen. So, I don't, as someone who does not have children myself, I can't go out there and preach and say, go have more children to fix this problem. I also don't know that really resolves it. So if you look at some Scandinavian countries that have some of the best social welfare systems, they're still not making a lot of kids either. So I just don't see that resolving itself. I don't know, I guess kids have gone out of fashion.
Yeah, you're seeing family formation a lot later, children a lot later. I'll just leave it at that. Juhi, you have any thoughts on that one?
I definitely want to weigh in on this. This is actually, like you, Brett, a topic near and dear to my heart, because I really feel like this is where the future of many countries depends in an environment of aging demographics. The way you turn things around is twofold: increase productivity, and we talked a little bit about that with investment spending, but then the other one is labor force participation. And so a couple of statistics that have always just made me stand back and say, wow, how did that happen? The female participation rate in Japan is now higher than in the United States. When did that happen? Like, I can't believe that when I see that. And that just says to me that we can do a lot more with childcare. For those who have kids, Mervin, it will make a difference. If you think back to the statistics that Dave put forth, it will make a difference. But I'm also thinking about an enduring shift that has taken place through the pandemic, and that has been the gift of remote work. I think companies finding flexible solutions for older workers could be a way to get many older workers to work part-time and offer a lot more ability to stay on. Again, the US is lagging other countries. When we talk about Scandinavia, the participation rate for older workers are much higher. So I think there's room to improve that. And then the final thing I guess I would say is just healthcare. I keep coming back to healthcare because I think that, when we think to the opioid crises that took place in this country, when we think about a lot of the changes that have taken place, affordable healthcare might be a way and means to get a lot of people more mobilized and willing to think about how else can they go about contributing and not feeling burdened by the cost of that. So that's my soapbox. I get off it right now. Thanks so much for
That's
asking.
okay. That's what you're here for. No, we appreciate that. All right, we've been cleared to land. Flaps are down. One last question, which I said I was going back to you, Mervin. What year does this area hit 1 million people?
And you're really going to try to pin me down on a year, huh? Well, the funny thing about forecasts is you look at past information to try to forecast the future, which is a little bit like driving a car only looking out the rear window. So based on our past growth, I think we're looking at 2045 or so. I'm just trying to count how many years it would be.
I'm going to
from
take the
E2.
under on that one.
Yeah, you're going to take it under?
I'm going to take the under on that one.
Yeah.
Then I'll ask you, are we going to add lanes to I-49?
I just want to put it far enough out so if it
that'll be
hasn't
helpful.
happened, I can say it hasn't happened yet.
Yeah, I'll take the under on 2045. Anybody else take the under with me on that one? Yeah.
Have more kids. You can make it by 2045.
All right, we're going to end on that one. Dean Weller, I think we've lost control, and it's back to you.
I didn't know that economists had any humor. That was the most humor we've had at one of these events. But on behalf of the University of Arkansas, thank you so much to the panelists for serving here today at the Arkansas Business Forecast Luncheon. Brett, Juhi, and David, as a token of our appreciation, we are giving $500 scholarships in your names to students to help defray the cost of tuition and living expenses. So thank you all. And of course, Mervin always does a great job. Thank you, Mervin. She's not here today. She couldn't be here. She wanted to be here, but I want to recognize Marianne Greenwood. Marianne Greenwood has been a driving force behind the Arkansas Business Forecast Luncheon for 28 years. She always helps us get the speakers. She has a dinner for the speakers the night before, usually at her house, where she hosts 60 to 70 people. But she had an accident and wasn't able to be here. But let's give her a hand, though. I know she's watching online, and our thoughts and prayers are with you, Marianne. And I would also like to recognize the staff of the Center for Business and Economic Research, particularly Mary Davenport, David Sordo, and Jeff Cooperstein and the Office of External Relations and other staff in the college. Let's give them a hand. So remember to fill out the forecast. Did y'all do that? You might win next year. So fill out the forecast form and leave your name tags at the table. And thank you all for coming again. It was wonderful to see people, and I hope you have a wonderful weekend.